Thank you for joining us today from across the globe. I'm Emma Newen, Head of Marketing Asia Pacific. We're delighted to welcome back Susan HayesCulleton, also internationally known as the Positive Economist. We'll be hosting our third Asia Pacific Economic Outlook webinar. Susan will take you on a tour around the Asia Pacific region, including Australia, mainland China, Hong Kong, Japan and Singapore, and provide economic analysis on the topics that are shaping your career and your economy. To find out more about our webinars, events, jobs and blogs, please visit morganmckinley.com or follow us on Twitter at morganmckinley. I'd like to run through some housekeeping tips before we start. We'll be recording this webinar and it will be available on our YouTube channel by searching Morgan McKinley Recruitment or on our website. Questions will be taken via the question or chat feature on our webinar control panel. We hope you enjoy the webinar and please join the conversation on Twitter at Morgan McKinley using hashtag Success Series and hashtag Career Ally. I'd like to tell you more about our very special speaker, Susan HayesCulleton. Susan is the Managing Director of HayesCulleton Limited, author of 3 books displayed currently on the screen: The Savvy Guide to Making More Money, The Savvy Woman's Guide to Financial Freedom, and Positive Economics. She's also a successful individual trader, financial trainer and speaker. I'm now delighted to introduce you to Susan. Hello, Susan.
Good evening, Emma, and thank you very much indeed for having me again on the Morgan McKinley Success Series webinar. As Emma mentioned, I'm going to be examining the APAC region today, so we're going to be starting off with looking at Japan. From there, we're going to go down to where you can hear Emma's accent is from, which is Australia. And then we are going to take a look at, of course, the engine driving growth nation of the world, which is China, before we finish up by comparing a particular sector-specific comparison of Hong Kong and Singapore. So as Emma said, please do join the conversation. My own Twitter handle there is @SusanHayes_. And also we're at Morgan McKinley. And of course, use the hashtag Success Series and hashtag Career Ally. So, as I mentioned, please do join in the conversation. It's always wonderful to hear from you and to hear your thoughts on the issues that we will be discussing today. So, let's start right at the beginning then, as I mentioned, and let's take a look at Japanese private demand. The reason that I chose private demand as a specific area of the Japanese economy is that the very first APAC Outlook webinar that I gave was in April. And I started off that day with Japan as well. And the reason that I did that is because the key story that shaped the Japanese economy at the time, and indeed has continued to do so, is that Abe was bringing the consumption tax from 5% up to 8% in April. Now, as you can imagine, it was very simple to predict what would happen. If taxes are going to rise on products that you're buying, you're going to buy them beforehand. And then as soon as the tax comes in, you're probably going to lessen off a little bit as you've brought forward some consumption. And of course, that's exactly what happened. Now, what I'm showing you here is what has happened in subsequent quarters. Now, before I go on, you've just noticed up here we have real GDP, okay? Now, real, the word real here refers to inflation adjusted. So this means taking into account inflation levels, which I'm going to talk to you about as well. But taking into account inflation-adjusted levels, this is how GDP is performed. And you'll see a kind of a strange code down here. And what this is Q over Q, which means quarter over quarter percentage change. So that is looking at how the elements of real GDP have changed on a quarter over quarter basis. So that's exactly what you're looking at here. And what I want to do is bring you right over here at the very end, and let's take a look. This comes from the Bank of Japan as of the most recent quarter. Now, when you think about any given $100 or 100 US dollars or million yen or anything else, any other type of currency that you could earn, think about what you can do with it. Well, you can spend it, you can save it, or you can pay tax on it. And that is what makes up GDP. So you've got consumption, investment, government, and net exports. So consumption and investment come under private demand. Public demand comes under what the government does. And then finally, you have net exports. And that is the amount that is exported to other nations, which of course generates revenue also. So on that period of time, you can see here that the most recent quarter, Q3 of 2014, you can see here private demand has dramatically fallen. And that is primarily driven by the impact of the consumption tax. Now, this is also shaping what is going to happen in future years, because in January, it is predicted that, oh well, not just predicted, Abe himself said that the consumption tax would rise from 8% to 10%. Now, do you really want to do that? And the question is, of course, is that the figures that will come through next quarter will define how that over here will change. Now, Abe himself says, we've done away with deflationary expectations, he said. And can I also point out as well, that while I'm talking about a decline in private demand, I also want to point out that wages are now rising, and you would expect them to. The reason that you would expect wages to be rising in Japan is inflation is increasing. So therefore, people have got a basis to go to their employers and say, we are experiencing a rising cost of living, which they're correct in saying, and therefore, we believe that is a basis for you to pay us more. So that is why you can see that wages are rising. And also, can I also point out that job vacancies are now plentiful. But when you take into account all of that put together, one needs to look at also this black line here. Look at the line here. Look at the real GDP line. It has fallen. And again, on an annual basis, the Japanese economy shrank 7.1% between April and June compared with a year ago, after Mr. Abe's government raised consumption tax from 5% to 8%. So the economy is declining. And what you've actually got is now you've had a level of artificial inflation. Prices are dearer, not because the cost of those goods are dearer or because there are more people demanding them, but simply because the government has put a tax, an increased tax on them. Now, you might say, okay, well, if there has been artificial inflation on that level, how about wider inflation? Because, of course, the whole reason for doing this is, yes, of course, the government puts a tax on goods so that it can bring in more money. And, of course, then it can spend on local services and public sector workers, etc., etc. Now, all of that, of course, we would take as a given. But also, remember, Japan has an ambition to rise inflation up to 2%. So, if you have got people spending less, as you can see here by the private demand, what has that done for inflation? So basically, has the objective been achieved? Now, the CPI fell to 1.1% in August, and September's figure is expected to fall to 1%. And in fact, it may even fall lower due to the impact on oil prices. I'm going to come back to you about the impact of oil prices and what's been driving oil prices, because that is also shaping quite a discussion in the economy right now. But I'm just going to leave that for a later section of the webinar. So we have got declining GDP, we have got declining demand, and unfortunately, we have also got declining inflation. Now, Abe is correct. We are not dealing with deflation, which is what Japan has struggled against for quite some time. We're not dealing with that. But we are dealing with declining inflation, which, of course, was the name of the game. So, in summary, despite the sluggish economy, the job market is tight, okay? It absolutely is tight, with unemployment at a 17-year low of 3.5%. And Japan's biggest labour union is calling for a rise in base pay of 2% next spring, which is the largest demand of its kind since 1998. So, if wages rise on an inflation-adjusted basis, if people can actually afford to spend more, well then, we can see that inflation will be achieved, and of course, the economy will rise. I mean, Japan's long-term growth rate is around about 0.5%, so it's not hugely demanding. You're not dealing with the levels of its neighbour China. You're not dealing with that. But what you are dealing with is if the economy is shrinking because of an artificial inflationary measure, well then, is it wise to continue on that path again in January? Now, the answer is, I don't know. And the answer is that the Japanese officials, and indeed the Bank of Japan, don't know at this point. Abe has said that he will make a decision on it, and of course it's not just him, it's going to be all of his advisors, etc. And Abe has said he will do that, and we will hear more on that during the first week of December. So in about 5 weeks' time, we will hear what that, I suppose, what the what the decision that it will make on that. But can I also point out that between now and then, you're going to have a lot more Q3 figures coming out. You're going to have manufacturing reports coming out. You're going to have an awful lot more information. We're going to see how the yen changes. We're going to see how the bond yield changes, which of course is absolutely tiny. We're going to see what more monetary policy, accommodative policies are going to be made. What I mean by that is, will there be more money printed, and on what scale? Remember, this is the very week at which the US is going to stop making purchases in the markets on a quantitative easing basis. This is the first time since they started quantitative easing of its origins way back in 2008. So there's an awful lot to happen in the next 5 weeks. But the question for Japan is, will that consumption tax rise again in January? And that certainly will be something that I will be discussing at length with you the next time we speak. So in moving on from Japan now, and let's take a trip south, let's go to Australia. Now, in the past, when I have delivered these webinars, unlike in the case of Japan, where I took a theme that I've discussed before and gave you an update, this time what I want to do is take a new theme and discuss this one at length. Previously, I've looked at I've looked at mines in terms of the actual mining sector, and what I've also done is I've taken a look at property, I've looked at the wider economy, I've looked at economic growth, and I've taken quite a broad view. This time I want to absolutely hone in on not just the mining sector within Australia, but what I want to look at are specifically the commodities of which they are being extracted and sold as well. So let me just give you a tour of the mining division in Australia, okay? Now, Australia's mining division is very price competitive on a global scale. Now, when I tell you that, that will also mean that as a result, Australia is going to be right up there in terms of selling to the world and is going to be one of the main, geographies participating in that market. Now, the division is export-oriented, and exports are expected to account to close to 70% of revenue in 2014 and 15. Now, what that means is that whatever happens outside of Australia has a far bigger impact on what happens in the mining industry within Australia. So the mining industry's contribution to the Australian economy is now at $121 billion a year. And in terms of export income, it generates $138 billion per annum. And here's the even more shocking figure, which represents over half, at 54%, of total goods and services. So that is telling you that whatever happens in this sector has a dramatic impact on not just the sector itself, but on also Australia's wider exports, which of course feeds right back into its economic growth. It has enjoyed annual growth of 5.3% between 2010 and 2015. It employs 180,000 people. Now, 180,000 to 190,000, I've seen varying figures, but give or take, you're looking at that sort of a region, within 6,600 businesses. And not just that, but it also employs another 600,000 people in support industries. At least 60% of the world's mines operate with Australian-made and designed software. In wages and salaries, that amounts to $18 billion. An additional $21 billion is contributed through company tax and royalty payments, and the industry spends $35.2 billion on new capital investment, $5.7 billion on exploration, and $4.2 billion on R&D. Now, if you want to take a look at those figures, particularly, I found a really good website. Now, it doesn't have all the figures that I've just spoken to you about. I've gathered those from numerous sources. But if you take a look at thisisourstory.com.au, it really is a lovely website about the impact of the mining industry, not just on the economy, but also on people's lives. So just one you might like to mention. Now, take a look at this graph here now that I have in front of you, which I took from macrobusiness.com.au, okay? And take a look at the shape of that graph. From 1989 to 2005, you can see that there has been a rise in the value of exports, but it's been slightly. It's been, relatively speaking, yes, it's grown, and it grew. I mean, if I could block out from 2005 onwards, and we had that to scale, you would see that it was actually quite an exponential rise. To move, for example, that blue line there was coal. To move from about $500 million up to over $2 billion, of course, represents a 400% rise. So we can see that. Now, however, when you look at that graph, and you look at 2005 onwards, and then you compare it back to 1989, you can see the sheer massive mushrooming growth of iron ore, coal, gold, and natural gas exports. And the most striking one of all is the red line. And that's the one that I want to talk to you about today. The red line is iron ore. Now, iron ore, let's think about this, because it's now Australia's largest commodity export. And I just want to talk to you about what's been going on in that particular industry. And then I'm going to bring you back to what's going on at oil prices right around the world, which of course has an impact on production of these commodities and extraction, and of course on the wider prices of commodities. Now, iron ore itself, remember that's the red line, you can see a massive, massive, massive growth of that, has dropped by about 40% this year, and the price has a flood of new supply from the world's biggest and lowest cost producers that's hit the market. Okay, so first of all, there has been an increase in supply. Now, in economics, when you have an increase in supply and the same amount of consumers, the price is going to fall. Okay, so we would expect that. However, in addition, and at the same time, simultaneously, fears about slowing demand in China, the world's biggest consumer of seaborne iron ore, have intensified. So that's also telling us that not alone has supply increased, but demand has decreased. Now, last Friday, okay, so we're looking at 48 hours ago in market terms, benchmark Australian ore for delivery into China dipped 0.3%, $79.8 a tonne, according to the steel index. But more importantly, that takes losses over the week to 1%, a percent in a week. So that is just telling you, when you look at the amount, as I remember, the commodities are responsible, or the mining industry is responsible for 54% of exports. Of those exports and of that industry, iron ore is the largest. Of that particular commodity, we are seeing increasing supply, we are seeing decreasing demand. We are seeing an impact on the markets of immense proportions. Now, iron ore is crucial for the largest miners, and let's get right down to the individual companies here that are responsible. They account for between 50 and 90% of earnings at BHP, Rio Tinto, and Vale. So how are these companies reacting? Well, BHP intends to increase production at mines in I was going to say WA, but in Western Australia by 65 million tonnes to 290 million tonnes a year by 2017. Now, that is almost an increase of 20% in production, increasing supply again. It's working to reduce costs so it can overtake Rio as the cheapest iron ore supplier to China. And this came out in a report published earlier in the week. HSBC cut its 2015 iron ore price forecast to $85 a tonne from $105, and its long-run estimate to $80, saying the big three were engaging in a game of chicken where nobody was blinking. Now, another way that you could put that then, of course, is that basically what you're seeing is literally a race to the bottom. The only way that these companies can survive at the scale at which a company like BHP or Rio can survive, by cutting costs, slashing costs, and of course the other way that they can do that is increasing their own supply. That is the only way to do it. Now, of course, this is great for the consumer, the worldwide consumer. This is great. But remember, if we're looking at the Australian economy, remember all of those jobs, like look at nearly 750,000 jobs right around the entire country is dependent on this industry. Look at the amount of property and property prices that we are looking at. Look at the impact on GDP. Look at the impact on the dollar. And you know what? Let's actually take a look at the impact on the Australian dollar. Because one of the things that I think is really, really interesting at the moment is what's been going on with the US dollar. Because the US dollar, when we look very, very briefly, I'm just going to mention a couple of things that I noticed going on in the US economy, because I could obviously spend an entire webinar, a series of webinars talking about the US economy itself. But the main thing that I wanted to point out is that the dollar is strengthening for a couple of reasons. And this brings me back to the oil price. Number one, the US is now producing huge amounts of shale oil and has now become one of the world's largest producers of oil. Now, that means that we're, again, increasing supply, just like iron ore in the case of Australia. Increasing supply. In addition, we're seeing a slowdown of global growth, and even Christine Lagarde herself said that we now have to get used to I suppose, a scenario or a time at which we're going to see mediocre growth as distinct from the sheer volumes of growth that we're seeing in places like China, which I'm going to speak about next. So, two things there. I've mentioned increasing supply from the US, decreasing demand on the part of the world. But number three, and this is often the one that people miss, number three is the fact that since you have now the ascent of a place like the US with an oil supply, you are seeing a decrease in the impact or influence of the OPEC regions. So the OPEC countries can no longer exert the same influence on oil prices around the world because, of course, they are no longer as big players or indeed having a monopoly on this market. You now have got players like, as I mentioned, the US. So as a result of that, you're seeing there are three reasons why the oil price is declining. So now we can see that the US is exporting, and as a result of that, people who need to buy those exports need to buy dollars. You're going to see an increase in the dollar there. Number two, you're also going, given the fact that we're seeing a very, very strong US economic growth, which you would expect surely after 5 years of quantitative easing, and there's other key reasons why the US dollar is increasing, and it's actually in many cases, like, again, I'm just going to touch briefly on this as an example, in the case of the euro. I'm delivering this webinar this morning from Ireland, and obviously Ireland is part of the euro and part of the European Union. So I'm ensconced all the time in European news. And of course, we are potentially facing deflation in Europe. And as a result of that, you're going to have people, not just people, but investors, either retail or institutional investors, who are going to take their money out of the euro and going to put it into the dollar. So it's not all just about what's going on domestically within the US. It also matters what's happening in relative terms. So if we look over here then, for example, at the yen, just back in Japan, remember that the more that the yen can depreciate, obviously, the better it is for exports. Now, the yen here has decreased by 5.66% against the dollar, and that is since the 9th of July 2014. Now, its August result, remember, was 1.1%. I would be expecting by Friday, this coming Friday, that we would be looking at a September inflation figure of 1%, which of course is half of the central bank inflation target. I'm not going to touch on sterling, but what I am going to look at over here then is the Australian dollar. So what you're seeing here is that the Australian dollar has fallen by 5.59% against the US dollar. Now, what does this mean? Well, just to go back to my iron ore story, Goldman Sachs estimates that the market will need to absorb a 110 million tonne surplus in 2015, which is roughly double this year's 60 million tonne surplus through mine closures, okay, so they probably will have to close mines, and restocking at Chinese ports. So that means that what you're looking at is that if demand is going to slow down, then you're simply going to have to build up in inventory levels, or else you're going to have to decrease the amount that has been generated from certain mines, as there simply is nobody to buy them. So in summary, you are seeing the price of those commodities fall, you are seeing the volume of those commodities purchased fall, but what I can say, which will benefit the US economy, the Australian economy, is that you've had a decline in the value of the dollar. So at least from that perspective, one or two things is going to happen. Number one is that when you see a decline in the value of the dollar, the Australian dollar, and if you're invoicing, for example, in a different currency, well, then that means that when you bring that currency back home, that it's worth more. So that means that the top line revenue figures can rise. If, on the other hand, you're invoicing in Australian dollars, and say, for example, a US company is buying your goods or a Chinese company is buying your goods, well, then for them, that Australian dollar costs less. So as a result of that, they may well increase the volumes that they're buying from, both of which will help companies, at least top line, if it doesn't flow to the bottom line as well. Just a final point I'm going to mention about Australian, if you just take a look over here at New Zealand. Now, New Zealand doesn't have the same characteristics, quite the same characteristics to its own economy, but it has seen the New Zealand dollar fall by 9.79%. And its inflation is at 1.6%, which is round about, now it's at the lower end of the Reserve Bank's objective, but it certainly is in that range. Whereas on the other hand, over here in Australia, and again, that's going to be driven a lot by property, and the cost of living in Australia is rising significantly. So That's at the upper end here of the Reserve Bank of Australia. But it is just important to mention that given the fact that Australia is the size, the physical sheer size of the country that it is of course going to have more commodities to export than New Zealand. But it's also important to remember that geographically the two nations are very close, and when you see one has fallen almost double the impact against the US dollar that the Australian dollar has had, that's also a point to mention. So before I move on to China now, what I'm just going to do is I'm just going to ask Emma perhaps to let me know if there have been any questions at this point.
Yes, Susan, there's actually been a couple of really interesting questions regarding Japan's consumption tax rate. So I'll ask one now from Thomas. So Thomas asks, the chairman of Bank of Japan is concerned about the next scheduled consumption tax rate hike scheduled in October 2015. Not raising the rate will cause a loss of investor confidence in Japan's monetary policy. Do you agree?
Do I agree? Well, what they have said, what the Japanese authorities have said is that for anything that they're going to do that will tax investors more, sorry, not just investors, but consumers more. So for any pressure that puts on the household, that they are going to release monetary policy to an even more loose stage than it's at the moment. But the thing is that let's think about how that happens. If a government goes out and buys bonds, okay, so let's say it goes out and it buys its own bonds, the impact that has is that it lowers the cost of borrowing, first of all, which has an impact on the wider economy through lower tax requirements. But what it also does is it benefits the people who have held those bonds in their portfolios. So they sell those bonds at a higher price, and then they go and then they probably buy other financial market securities. And the idea is that eventually it trickles down to the real economy in a way that through either higher returns, which is then given in higher bonus payments, or it's given in higher wages, etc., etc. The problem is that it can take an awfully long time for monetary policy to actually affect the individual at home, who is running a household, has 2 children, is running a car, is struggling against inflation, etc. Whereas on the other hand, the fiscal policy, and in this case the fiscal policy was to increase the consumption tax, that affects everybody immediately. So do I agree? To a point. To a point, I disagree, because it says, like the Bank of Japan and the wider Japanese authorities have made no secret of the fact that this is coming. And as a result of that, investors have plenty of time to digest this information. And the very same thing happened in Europe. You know, we thought it was absolutely unthinkable that we would have a big bailout. We had one. We thought it was absolutely unthinkable that the ECB could buy government bonds to bring down the bond yield. It happened. And the thing is that in these cases, when you give the markets enough time to digest the information, it goes from absolutely impossible to run-of-the-mill. Now, on the other hand, how I do agree with that particular person's point is the fact that the impact takes an awfully longer time to hit the individual. So from the perspective of investors, I think they are going to clearly get the message that it is, you know, what's going to happen on one side is going to be offset by the other side. But my concern would be more so, and here's where I would agree with that individual, my concern more so would be for the consumer at home, the individual who cannot see the impact of monetary policy on their particular case, whereas they'll feel the impact of an increase in consumption tax right away.
Great, thanks for that, Susan. And
I just wanted to...
Yes?
Sure, go ahead.
Are you ready for a second question regarding the consumption tax too, or do you want to continue? Yep, okay, so we've got another one. Given the negative impact of the Japanese consumption hike back in April, the first one, do you see further deterioration in the Japanese economy? If not, what are your opinions about possible actions can the Japanese government or the Bank of Japan take in terms of fiscal monetary policies to boost the Japanese economy?
Okay, do I think I will see a further decline? Okay, right. Again, I suppose coming from a country where I think there's 2 parts to that question. Do I see further deterioration? And if not, or if so, what could the government do? Okay. So first and foremost, do I see further declines? When I think about a consumption tax on consumption goods, like what is it that we buy every day? Well, we buy food, we buy shelter, you could say, through rents or through property, we buy clothes, we buy all of these things. And the thing is that all of those have quite a short shelf life. So what I mean by that is, when I consume food today, well then it's gone, and then I have to buy more tomorrow. Clothes, on the other hand, I might wear them for a couple of months and then I need new ones, either because, potentially there might be a new fashion out there that particularly people might want to enjoy, or on the other hand, I need new glitter garments. So the point is that the impact of the consumption tax can't last forever. It cannot last forever because very, very simply, the things that we consume, remember, this is on consumption, not on investment. Investment, you can invest today and not invest again for 20 years. Consumption is different. So I don't see it having the same impact for certainly in the coming months. I don't, because many of the things that people brought forward their consumption on will, at this point, like that was April, we're now in October, we're now looking 6 months later, many of those things will need to be replenished again. Now, the second thing that you mentioned, sorry, that's not to say that the economy won't continue to decline. I'm not necessarily saying that. What I think the main differentiator would be, the main pivotal thing that I believe needs to happen in Japan are real wage rises. So people do need to increase their wages, and I wonder if that is something that the government can help with, either in some sort of state-given subsidy to employers on a temporary basis to increase wages so that they don't necessarily feel the pinch, but on the other hand that the employees can get the benefit of it, or whether there is going to be some sort of law reform where you might be able to decrease taxes on labour, for example, and therefore then the employee gets more of the wages that the employers are giving them because there would be less given to them in tax. Effectively, what the Japanese economy needs to do is to put more money back into the pockets of the individual. They have put money into the pockets of investors through quantitative easing. We've seen that. We have absolutely seen that. They have loosened monetary policy to the point of where it costs basically nothing to borrow. So they have done what they could to increase demand there. I mean, if they wanted to go absolutely, totally non-traditional, completely unorthodox, what they could do is go out into the open economy and actually buy up businesses and buy up real estate and buy up other various assets themselves directly. They could do that. But it's going to be very hard. It's going to be very, very selective to do that. And also that is something that there is very little experience of having done in the world previous at a wider scale than what the Bank of Japan have done already. So what I think needs to happen is you need to put money back in to the pockets of the individual in Japan. Now you might say, well, they did the total opposite of that by the consumption tax, but can I also point out that consumption tax was expected to generate between 4 and 5 trillion yen. At the same time, the Bank of Japan and the Japanese government had planned to spend 5.5 trillion and on giving money in transfer payments to the less off members of Japanese society. So the idea is you take money off everybody and you give it to the poorer people, and poorer people tend to spend all of that they have because they simply can't afford to save. And then this itself would rebolster the economy. Now, it hasn't quite happened like that, but then again, often economic developments don't happen overnight anyway. So what I would say on that is, what can the Japanese government do? Either it could, in some way, through a state subsidy, and I've seen this happen in various different countries, not to put money back into people's pockets, but rather to increase employment. And in the case of Japan, I mean, really, it's got an unemployment rate of 3.5%. It's basically at full employment. So it's not going to necessarily help that because it doesn't need any help. But instead, if it could give some sort of a state subsidy to employers to pay their employees more, or else decrease labour taxes, it's national insurance or income tax, etc. Either of those might be a possibility on a fiscal basis. Monetary policy-wise, I think that they've really run out of an awful lot of road. But fiscal-wise, that may be something that the bank could certainly look at. Perhaps at this stage, Emma, we'll move on to China. Would that be okay with you?
That'd be great. And then I've got a couple more questions as well. So they're coming through thick and fast. So thanks everybody for your questions and participation. So yes, please continue and I will answer them later on.
Perfect. That sounds wonderful. Okay, let's move on now and let's take a look at China, because China was quite headline grabbing this month, I should say. Because if you look at the graph in the top left-hand corner, you can see here that China has overtaken the US in real GDP terms. Now, I remember, reading this newspaper article, and I thought, wow, I thought that wasn't going to happen until maybe mid-2020s, or at least 2020 at the very beginning. And also, I hadn't basically heard of, the Chinese economy creeping up on the US economy that fast. So what exactly happened? So I wanted to start off today by pointing out exactly what happened. And again, I'm bringing you back to a word that we have referred to over here. we refer to this quite often, and that is, again, real. And real, remember, refers to inflation adjusted. So when you look at inflation adjusted GDP, let's take a look at the figures here, and let's look at what has just happened over here that I need to tell you about. So China's gross domestic product, or GDP, is worth $17.6 trillion based on purchasing power parity. When you look at what the renminbi, one renminbi can buy relative to what $1 can buy. Now, when, on the other hand, you look at the US economy, in comparison, I just say that figure again, so 17.6 trillion. When you look at the US economy, so when you have adjustments made for China's lower cost of living, this means that the Chinese economy is slightly bigger than the US with 17.4 trillion. So we're looking at around about 200 billion of a difference. But, and here's the point that I wanted to make, is we've seen a lot of headlines about the fact that China is now the largest economy in the world. But if we were to, if I could just, put my mouse over this word real, if I could just eliminate that, and if I was just to look at the GDP figures themselves, not adjusted, okay, not adjusted for purchasing power or the cost of living, the US economy is worth 17.4 trillion, whereas China's is 10.4 trillion, which is 7 trillion behind it. So what I just want to say is that, in economics, it's important to really dig down and to understand what really the differences are between these economies. So when you see that China has overtaken the US, it is on an inflation-adjusted basis, and of course that would be the case because since there's a lower cost of living, since goods in China actually cost more, then of course what a dollar can buy in China and what a dollar can buy in the US is going to be totally different. But when you look at the simple figures of how much the economy generates and don't break down those comparisons, the US is still ahead. Now, when you move over here to the right-hand side, and this is really where I wanted to get to. I wanted to just discuss that economic headline, but I now just want to really get into what's going on in the Chinese economy. When you put the Chinese economy with other developing economies, you can clearly see, and other developing economies like India, like Russia, like Brazil, of course. I'm sure many of you heard of what happened in Brazil yesterday. The stock market gave its verdict of unhappiness. But anyway, we leave that to one side. When you look at the developing economies, you can see here the blue line. Okay, the blue line is developing economies, and as you can see, that is driving economic growth around the world. And that is why for countries like Australia, and for countries like Japan, and for countries like US, that is exporting to these nations. And to these economies who are gaining the traction of these developing economies. That's why their growth is just so, not just important, but impactful in our lives. Now, then you can see down here we've got relatively sluggish growth here on the part of advanced economies, which you might expect. Actually, I'm just going to touch on this very briefly. 2 weeks ago, I was with Morgan McKinley and I was actually speaking to the London office about, in London, Morgan McKinley's headquarters in the UK is in London, and they brought me over to deliver a talk on the future of the emerging markets economies. And when I actually looked at this, and this would encapsulate, as I mentioned, China, when I looked at the growth of the emerging markets economies, they are getting the foreign direct investment inflows. They are driving forward in terms of trade, and they are doing a whole lot of other things. But I do want to point out one thing, and that is that innovation in emerging markets can often be faster than in advanced economies. And you may say, well, why is that the case? Because surely advanced economies invest more in R&D, research and development. And you'd be right in thinking that. That's exactly what happens. However, if you're an emerging economy, you can leverage the benefit of that research, development, and of course testing far quicker because the work has been done for you. But at this point, many of the emerging economies are actually catching up with the developed economies. And that is one of the reasons of why we might expect the emerging markets to enter into a slower rate of growth, because the innovation gap between the two is closing. So it's just a key point to remember, like the emerging markets as we have seen them may not be the emerging markets as we're going to see them in the future. Just a key point, and it was a point that I was at pains to mention that night in London 2 weeks ago with Morgan McKinley. Over here, when you look at the countries with the highest GDP growth in the last 20 years, you can see number 3 down here is, of course, China. Now, from 1980 to 2009, China expanded by an average of 10.1% annually. 10.1% annually. Now, that has brought the Chinese economy on this, like for here from 1980 all the way up here, as you can see, a level of exponential growth. But there's one point that I really want to zero in on in China, and this will have an impact not just on the Chinese economy, not just on the Chinese household, not just on the APAC region, but the total and utter world. And look over here. Expectations are being scaled down in all regions. So we can see what's happening in the advanced economies. We can see what's happening in the Eurozone. Again, as I mentioned Brazil yesterday, we can see what happened in Latin America. But look here at developing Asia. And why is this? Well, one big problem I see in China, and it's a very, very large problem, and that is the size of the debt is massive. Total Chinese debt. Now, when I say total Chinese debt, I'm saying government, companies, and households has virtually doubled since the financial crisis to about 240% of GDP. Now, to put that in relative terms, 240% of GDP in China, it's 400% here in Ireland. Okay, so it's not beyond the bounds of possibility that can be dealt with. But I know myself from being in a bailout country, it's not about the amount of debt that you have. To be honest, that's pretty irrelevant as long as you can always find somebody new to borrow from. You can continue to borrow from them to pay off the other. But let me tell you what the real problem is actually the cost of servicing that debt. And that is really what may present a huge problem for China. Debt service charges, okay? Now, assuming an average interest rate of 7%, are set to reach about 17% of this year's prospective GDP. Now, can I tell you how much that is? That is $1.7 trillion. To put that in context, that is almost the size of the Indian economy. That is the entire size of the Indian economy. It is also the very same amount, that 1.7 trillion, the private companies invested in factories and equipment in the first 9 months. So that's a huge amount of debt. Now, when you look, I'm just going to go back to one number. That's 17% of this year's prospective GDP. The growth rate expected on the part of China is 7.3% of GDP. Now, I'm going to put this to you another way. I am a household in China, and I earn $100. Next year, I'm expecting to earn $107.3. So I'm expecting a wage increase of 7.3%. However, next year, I'm also going to have to pay, of that $100, $17 in paying off debt. So that means that next year, even including a very, very strong wage increase, I'm still going to be down than, my household is still going to be less well off than it was this year. Because when you see a servicing interest rate, or when you see that the economy is to spend 17% of itself on simply paying off debt, not even paying off debt, this is servicing debt, and it's only growing by 7.3%, you see a big problem. Is that this could stifle the economy. Now, you may say, well, how did China get to this place? Well, remember, the collapse of the US demand in 2008, it absolutely hammered China's export sector. And it threw roughly 30 million people out of work in a matter of months, which obliged China to launch a stimulus program that drew impetus from the ambitions of local governments to demonstrate their manifest destiny. So we do know that. We're absolutely sure on that. And when we actually look at the impact on the individual company, so to those of you tuning in from China today, how is this affecting your company? Well, companies are estimated, now this is Standard Chartered Bank are estimating this, the 32% of new credit these days is simply used to pay the interest on existing debt. So it's not even being used to pay off existing debt. It's just used to service the interest on that debt. So when I was telling you about, the household that makes 7.3 extra and pays 17%, like when you're looking at companies, those figures are an awful lot, are even more stark. So that 32% of new credit is just used to pay off interest. And of course, in accounting terms, that interest then becomes capitalized onto the balance sheet, and then that interest has to generate interest, creating a compound interest problem that is not welcome. Consumers are compromised now because overall debt service charges now equate to about $1,290 out of their annual per capita GDP of $6,800. So when you're looking at $1,200 as a percentage of $6,800, you're looking at around about 18% of people's GDP, almost in line with the government, is being solely. And again, that's only to service the debt. So what does it do? Well, does it now borrow more with a view to building up the economy further? But remember, if you're paying that amount of interest, and if the economy is going slower, the ROI, the return on investment of that actual investment, is falling. So now you've got investors, and this goes back to the person who asked me the question about Japanese investors. What about the Chinese investors? Because they are not going to see as high a return on investment. And if they're not going to see the return, why would they do it? And if they're not going to do it, well, then they're going to have to be incentivized more incentivized to participate. How are they going to do that? Probably what? Probably an interest rate increase, which goes back to the start again. So, Beijing needs to navigate between an unsustainable credit splurge and a collapse in domestic demand. Because if it doesn't continue to borrow and fund the economy, well then what you're going to look at is you're going to look at a slowdown of domestic demand. And if that was to happen, that would literally decimate resource exporting economies the world over. And that's why I wanted specifically to focus on that element of the economy in Australia today. Now, just the very last thing I'm going to mention on China before we move on to Hong Kong and Singapore is that in the case of China, and I've mentioned this on every single APAC webinar that I've given to you this year with Martin McKinley, every time, the amount of GDP dedicated to investment is 48%. So when you look at the economy, 48% of it is devoted to investment. How has that been funded? It's been funded by borrowing. So if you're going to scale down the borrowing, you're going to scale down investment, which means that it's going to have a dramatic impact on the Chinese economy. In Japan, consumption is responsible for 60%. So you're looking at two fundamentally different economies there. But in China, it would have a dramatic effect. What China's role, I suppose, or what the Chinese economy, or at least the Chinese authorities are trying to do is turn the Chinese investment-driven economy to a Chinese consumption-driven economy. But, on the other hand, because of the sheer amount of debt, that's not going to be very easy, as well as trying to turn the habits of a nation. So there is more required here in China. And according to the IMF, the priority areas that require structural reforms are the financial sector, state-owned enterprises, the exchange rate, and local governments. And effectively, what this means is reform should aim to eliminate distortions and implicit guarantees, strengthen institutions, and give the market a more decisive role. And that is on the part of the IMF. So again, you're looking at a huge cultural, social, governmental, and economic shift in China, is what is trying to be orchestrated. But I'll tell you this much, there's no question that the Chinese economy is going to provide an awful lot of interesting developments over the coming years and even months, as we look at how they're going to either, follow that very thin line between a slowdown of domestic demand and increasing debt, as well as paying down debt, as well as those restructuring reforms, as well as trying to turn an investment-led economy into a consumption-driven economy while keeping people happy and safe and relatively prosperous in their own environment. It's going to be one to watch. Now, just on China as well, I also wanted to look into the future, and this here is a report from PwC, PricewaterhouseCoopers, and what you can see here, you can see here that when we look at the trade links between who is trading with who, the largest, and this is 2030, okay, I just want to look up here, 2030, okay, 2030. So the largest trade relationship between two nations appears to be China and the US, okay? The two largest economies in the world trading with each other. The second one is China and Japan. But the third one is China and South Korea. Interestingly, the only inter-European one is the fourth one here between Germany and France. After that, we have Japan and the US. But after that, we have China. China is happening over and over and over and over and over again. So that's why it's so important for us to look at the Chinese economy, because they are such a huge importer and exporter in the world, and they are going to have, with the other economies, like as I mentioned, India, Brazil, Russia, South Africa, and some of the other frontier economies, they are going to be the people who are going to drive the consumption of the world in the future, and that's why it's so important. As I mentioned, this economy is one to watch. So the very last two areas I'm going to look at now are Hong Kong and Singapore, and what I wanted to do this time is rather than take each of them in their own right, I just wanted to look at one versus the other. Okay, so who is going to be the future financial capital of Asia? Who do you think is going to be the future financial capital of Asia? So could it be Hong Kong? Well, let's take a look at Hong Kong. First of all, it's got, obviously an advantageous proximity to China. Given all that I've said about China, you can see how that would work. But also, it has a maturing market. And what I mean by that is that, in particular, it's opening up. Yesterday, I was watching CNBC yesterday, and I saw that there's actually been a delay and a technical fault of opening up the Hong Kong market to the Chinese market. But that is going to happen. I mean, that is going to happen, and it's going to happen very, very quickly. And Shanghai is going to have opened its doors to Hong Kong and vice versa, which now means that for the retail investors of both countries, you are now going to have more opportunities, which may bring down the cost of borrowing or the cost of equity on the part of companies, and of course will have a pool of new investors, potentially driving up prices, etc., etc. But also, it is the third equity and IPO capital in the world. Now, the first two, by the way, are New York and London. And so far, Hong Kong has had 67 new listings, and they're valued at about 17.6 billion. In comparison, though, Singapore trails at 19th versus Hong Kong's third. It's had 8 listings worth just 1.9 billion, and that's according to Dealogic. Now, also, I mentioned there about access to the Shanghai market. Now, it will allow for the first time Hong Kong and foreign investors with offshore renminbi access to the Shanghai market. So that is going to be a very, very large advantage. Now, also, when you look at the banking assets, in Hong Kong, there was 2.32 trillion of banking assets in Hong Kong, just 0.76 or 760 billion banking assets in Singapore. When you look at the average bonuses, you're looking at $32,700 in Hong Kong versus just $20,300 in Singapore. Now, if I was a young graduate coming out of university and I wanted a fantastic career in the East in financial services, perhaps I may be attracted by this growth, by the exciting world of the equity markets and, the razzmatazz of the IPO markets. Lots of new developments in Shanghai with the Shanghai Exchange. Got a great proximity to China and would have a huge amount of possibility, given that its proximity to China, which is now going to be, going to have. It already had 10% growth. It's looking between 4 and 10% growth in the medium term. Is that where I would want to be? Or if I was somebody who was maybe in my late 20s looking to really ascend the ladder before I'm looking into the next stage of my life, which might involve a little bit more work-life balance, maybe Hong Kong would be the place to go. However, let's take a look instead at Singapore, because Singapore is interesting in the fact that it has a huge amount of financial companies. Headquarters are based in Singapore. So therefore, in terms of gaining access to mentoring, in terms of where the real business is done, in terms of being on the management team, in terms of getting on the board, maybe that's the place that I might be looking for. And also, while equity and IPO would be the name of the game in Hong Kong, Singapore has attracted dozens of global trading firms, exploiting its position as the world's largest bunkering port, straddling sea lanes to and from China. And Governor, the world's 4th biggest oil trader, has added about 20% to its staff in Singapore in the past 9 months. So if I was looking at commodity, foreign exchange and wealth management as a niche, well then Singapore, in that case, would have the upper hand. Now also, commodity derivatives are the fastest growing part of the business on the Singapore Stock Exchange. Global exchanges are building up their Asian presence through acquisitions in Singapore, with the Intercontinental Exchange buying the Singapore Mercantile Exchange and Deutsche Börse's plans to build a clearinghouse in the city-state. So when I look at that particular area, and when I look at, if I'm solely looking at that particular world, and remember commodities are a business that is going to be hugely dependent on global demand, again, as we mentioned in Australia and China, etc., maybe Singapore is the place to be. However, when you look at corporation tax rates, Singapore has a corporation tax rate on offer that is lower at 16.5%. Than in the case of Singapore, Singapore has a lower corporation tax rate than Hong Kong. So as a result, now I am in a country, I'm sure many of you have heard about the Irish corporation tax, and like we have been absolutely spectacular in attracting foreign direct investment into Ireland. Even in 2013, Ireland attracted 46% of US foreign direct investment. And that was, we were still in the bailout, still in recession, and we were still able to do it. Of course, it's because Ireland has lots of attractive attributes, but one of the key reasons, of course, is the corporation tax rate. So I know just how important that tax rate actually is. Now let's go back to lifestyle, okay? Let's go back to that young graduate, or that person in their late 20s, or that person in their early 30s or 40s, who is now thinking about getting married, thinking about having children, etc., and they want to put down roots. Yes, they want a great career with, lots of exciting prospects and personal development, but they're also looking out the other end. Let me tell you that while the bonus is lower in Hong Kong, one of the key things that is very, very different is, according to Savills, which is a property agency, it estimates the prime residential rents in Singapore averages at $1,700 per week versus almost $2,500 in Hong Kong, which is now, on that score, according to Savills, the most expensive city in the world. So, yes, I might earn more. Yes, I might have a higher bonus. But when you think about not just top-line revenue figures, when you move that to the bottom line, when you look at what the household is going to have left after, it may well be the case that Singapore trumps it. The cost of living per employee, right, when you include living, rent, and working space, in Hong Kong, it's $115,700. When you look at Singapore, it's $74,900. So as a result of that, as a business person, as an employer, Singapore is also a place that might be of more interest. Singapore's economy is doing very well. It's built on property, it's built on financial services, built on real estate, built on luxury goods, built on consumption. And Singapore is an economy that I've been watching for quite some time. And I watched it with interest because it mirrored the Irish one, and I'm conscious, very, very conscious of that, and I'm constantly looking for fault lines there. But it is certainly the economy that may well trump Hong Kong if I was somebody looking for standard of living, looking for a very good wage in the commodity FX wealth management area. If I was an employer, it might be the place I'd look for. But if I'm looking for the really fantastic, sparkling growth of, the link with the Shanghai market, with the equity, with the IPO, with proximity, and of course with higher, possibly much higher rates of pay, well then it may well be Singapore. But can I just finish the webinar by pointing this out? And this, I think, really is what epitomises what's going on in the APAC region. If you were to combine Hong Kong and Singapore together, and if they were not to think of themselves as individuals but as a team, two centres combined are expected to overtake global leader Switzerland, possibly by 2015, according to the Boston Consulting Group. And it reckons that as of the end of 2013, total assets under management in Hong Kong was 2.2 trillion, which was just behind Switzerland at 3.7 trillion, and Singapore came third at 1.4. So if you add 2.2 and 1.4, you get 3.6 trillion, which is right on the heels of Switzerland, a global financial centre. And that is where I wonder if the access of the financial world, not just of Asia or not just the APAC region, but of the financial world, may well be turned east. So at that stage, I'm now just going to say that for anybody that might like more information on any of the individual topics that I'm talking about, please do. You can find my area, or you're able to find my blog posts, and my also I launched podcasts last month as well, and my TED Talk. All of those are available on thepositiveeconomist.com. So please, anybody who might be interested in any, whether it's economics, entrepreneurship, or stock market topics, I have an abundance of articles in there, and of course you can register for the monthly newsletter so that you don't have to check in with me often. And at this point, I'm always going to finish with the same point, the same quote that I always do. I think that it's absolutely fantastic